Up YouTube, this is the Working Investor. In this video, we're going to talk about some of my holdings, what the plans are. Also, we're going to talk about the Yieldmax fund manager. Jay came on the Kamirs, and I was able to ask him some questions. We'll talk about some nuggets that I've learned from the interview with Kamir, and we'll talk about how these funds could be potentially a game changer in retirement. And we'll talk about the new 4% rule that I consider as a litmus test. Let's get into the video. So first I wanted to talk about a little bit of the discrepancies. So yes, I have $126,000 invested. Some of it is a little bit is margin. I think about 14,000 roughly is margin right now. And you see here, it says that, this is according to the Snowball Analytics, and there are lots of discrepancies between different dividend tracker sites and apps. So I just want to put that out there. According to this, my average of all my holdings is 60%. Again, none of this is financial advice, tax advice, legal advice, personal advice. This is just I'm just sharing you as a retail investor what my journey is and what my thinking is. I could be wrong in many things. I advise you to look into professionals who can help you with this. But if you want some entertainment and see what I'm doing, this is a good video to just entertain you and show you what I'm doing. So yeah, you see here's the key, 60%. That's pretty interesting. So I know some people think about, when it comes to, the average, if you just Google the average income in America, I don't believe it's 37,000. I think the average income is around 60,000 in America. You could see over here that, let's look at California because of the expensive cost of living. So it says, if you Google it up, you could see that somewhere between, $4,500 a month is like the cost of living in California, which could be wrong. There's a lot of debate. Is it 53,000? Is it, 70,000, somewhere in that range. So, I think a lot of places you would see would pretty much have a similar consensus that $5,000 a month is kind of like a living wage in the more expensive places in America. And then if you can extrapolate to cheaper places in America, that could be enough, more than enough. So $5,000 or $4,000, somewhere in that range, is actually life-changing money. So when it comes to the, I call the 4% rule, my 4% rule, not the traditional 4% rule. As an option trader, the best return that I've been finding with like leverage funds or doing zero-day expiration funds or very volatile stocks is try to get 1% return per week. 1% return per week is easy math to remember because 1% return per week equates to 52% annualized return, which is incredible. And if you think about a $100,000 portfolio, if you have a $100,000 portfolio and you're kind of getting 1% return per week, that's about $4,000, roughly $4,000 per month, which is kind of life-changing money. Anytime you get to between $4,000 and $5,000, of course, needs and expenses could vary widely. But I think you could probably argue that for the majority of Americans, for the majority of cost of living, $4,000 to $5,000 is a game changer. It's pretty much if you have $5,000 a month. Which is 5% in a month, which comes out to be 10 months is 50,000, 12 months is 60,000. That is an entire living wage, as we saw. An entire salary is 60 grand. So $4,000 or $5,000 a month is an entire game changer, which pretty much can replace average salary, a single person salary, not a household salary in the United States. So that's why I feel like the key thing is if you have a 60% annualized return in the high yield dividends, I would say yield on cost would be more important to talk about. That would kick, 60% equals $5,000 a month from $100,000 in the portfolio. Of course, it's an easy way of thinking about the math. So here I'm going to show you in the app kind of like the breakdown of the funds. It has a nice way how they break down the funds. If you go here to analytics and then you scroll down over here, you can see the holdings. Again, I'm not telling you to do these holdings, but if you toggle it to the right, it can give you the return. And you see the upper number tells you the yield. And then the lower number tells you your yield on cost. So some of my yield on cost is greater because I got it in good prices, and some of them are worse. So you could see here, for AIPI, 35% is my yield on cost, but really 34% is entry. AMZ 39 entry, but obviously my yield on cost is 42. Bitto 58%, but my yield is 60 and change. Crash, you could see it's actually pretty, 61, but obviously I'm down with the inverse, so it's 41%. I'm not sure how accurate it is, but they say that dips is 13.84%. I doubt that's actually pretty accurate. I think it's actually last distribution Yieldmax announced, I think it was around 50%. So that's a little off there. Phoebe, you could see here, my yield is 48.89. FEPI, even though it's 24 and change, mine's like 25 and change because I got in a good price. Getting good prices is very important to keep your yield on cost down. I think most people would agree with that. Fiat 105, GAAX, 24% for me. Misty, my yield on cost is 185%. NVIDIA, my yield on cost is 52. Again, the bottom number is my yield on cost, top is yield. You know, just so XTTE is pretty much 15%. It's pretty much one of my lowest yielders, XTTE. But if you look at it as a total, as I showed you in another video, so far XTTE 6 months, comparing it to the underlier, has outperformed the SPY. So they've done pretty well in total returns, and they give a nice dividend. But total returns, they've actually beat the S&P 500, the underlying index, because they have the extra premium. And you see here, I have this new fund, Yieldmax. Again, I got it in a good price, so they say it's 68%. Now, of course, I want to point out there is some crazy, wild discrepancies between my income estimations with these different analytics. So I always try to look at the lower one because I want to be more, because they could fluctuate from month to month, week to week. So this one says that it's 60%. And that's, my target is around 50, trying to get to, if I could get to 60 overall, that's great. Like I said, 60% on a $100,000 investment equals $5,000, which is meaningful amount of money, life-changing money for most people. And that's without using any margin. But if using margin, you could make that even, you could turn 100 grand and bring in almost like 10 grand a month. Not telling you to do this, but just want to point that out. Now, if you look at the, my dividend tracker, I plugged in, the same metrics, and you'll see here, on the other one, it said that my income will be 76, 75. This one says the income will be 67, and then the yield yield on cost, they're saying, is 64. So, but then even when you go, that's when you go to dashboard, and for whatever reason, I pointed out in other videos, if you go into like your actual portfolio, the numbers go down, and I don't know why there's a discrepancy. There's no different data in there. It's only tracking one portfolio. For whatever reason, you see here that it says the yield is like kind of 54. So I just go with the lowest value so I don't, get surprised or anything. And then they say my monthly income is about 5,600 basically on these. So yes, so this just wanted to show you there are a lot of discrepancies with the different trackers. I like to go with the lowest number just to give myself the most, I don't get any shock when I see lower than normal. I'd rather be on the more conservative side if I have to. The question is where we go from here, right? So, and before we get to that, just wanted to talk about margin rates. Obviously Robinhood is pretty much kick butt when it comes to margin rate. I've noticed, I've had a Robinhood for quite some time, and they pretty much change the rates very quickly based on what the Fed does. So when the Fed lowers the rate, usually within a day or two, I've noticed they've not, I'm not going to tell you they're going to do it all the time, but they've pretty much consistently just changed it, based on the Fed. And right now you can get for if somebody has less than $50,000 in margin, their highest margin rate is 6%, and their lowest is 4.99. If you compare that to, let's say Interactive Brokers, I found from my searching has been the most competitive other than Robinhood. And you see here, Interactive Brokers, their lowest, their rates are, I think it's 6.33%. And they show you each rate is 13 and change, Fidelity's 12 and change, Schwab is 12 and change, Vanguard is 12 and change. Of course, they talk about, they even show you the breakdown, if you have more invested. So Interactive Broker will go down to even 5.67% if you have enough money in there, which is a very small amount of percent of the people. And you see that all of them kind of drop their percentage if you have more money in margin. But obviously, like Interactive Broker, I've noticed consistently over and over again that they've been pretty much one of the lowest margin rates. Robinhood pretty much consistently, I think, has been top of the pack. But then Interactive Broker is like right behind them usually, or really close, or depending on the situation. From what I've been monitoring and noticing, if you see anything better, I would love to hear about it, because getting cheap money or almost free money is amazing. And when you think about 6.33% or 6% or less than 6%, that's on an annualized basis. And if you're bringing in, somewhere between 4 or 5% a month, you've pretty much covered your entire interest costs in a little bit, like in about 5-6 weeks. You've pretty of the year of what you've generated pretty much cost, it covers your cost to carry right away. I'm not giving you financial advice, but a lot of investors think of it that way, that, hey, like just, you know, 10 months of the year, you're paying about up to 2 months of the year, you're paying for your margin. For a portion of the account is margin, not all. And then the rest of the 10 months, you're just getting free cash flow coming in. So, of course, there is inherent risk. It's a double-edged sword. Absolutely. So, as I spoke about earlier in the video, where do I go from here? I always want to think of the next step. And guess what? There's always going to be more funds coming out. Based on the interview with Jay, he did mention this. There have a lot of funds coming out. They couldn't talk too much about it, I guess, until they, get the whole, SEC filing and approval and everything. They kind of alluded that there's going to be some theme-based funds coming out and some more really cool strategies coming out in Yieldmax. And I'm sure many other companies out there are coming out with amazing funds. I do like to have a little bit of a variety of different companies. Of course, sometimes sacrificing the yield, because Yieldmax pays pretty darn well yield. So the green, as I mentioned, what is not green is where I'm at right now in my holding, and I'm actually up in a lot of my positions and maybe down in some of my inverses. And the green is like where I want to build it up. So my AIPI right now, we'll go down the list. That's the AI. It's an AI play, and they pay 34%. Now, the reason why, when you're starting to dip more into margin and you're using a loan, you need to make sure it makes sense for you. Because if your margin rate's 6%, 7%, maybe 10, 12, 13%, and you're making 10%, you're not really going to make any money. You got to justify using that margin. So a lot of investors, this is where a lot of investors are thinking, and you have to make your own decision. But in my mind, I feel like I have to justify the cost. So I'm looking for something at least 20, 30 minimum percent to make up, so I can have that spread between the margin and what I keep. And then so that's why AIPI pays 34% yield. They target that. So I was thinking of bumping it up from $5,000 to 10 grand. And then the YMAX, I'm up to 10 grand right now with YMAX. I'm thinking possibly of bumping that up to 20 more grand, but I need to find a good entry price. Right now, everything is so darn expensive. It's hard to find a good time to buy. Everybody's very optimistic right now. So, you need to, I'm trying to find a pullback to get in more. And I've been getting in with the pullbacks. I haven't just sitting on the sidelines. I've been every month pumping in money when I see pullbacks. And then Ulti, I'm at 20K. And I was thinking of bumping it up possibly to 50. And that would bump up my 5,500 or whatever. My goal is to get it up to, I have this, a cool goal. Obviously, as we build, it's good to make little mini goals along the way. But a cool goal is if you make $8,333, if you hit 8,333 per month, that means you keep a cool 100K a month in dividends. Guys, 100K a month in dividends. That's ridiculous. That's ridiculous. That's a cool number to get to. So I'm trying to see if I can get there, but the question is when I will get in, how much will I dip my toes in margin? I want to do it in a smart way. So the question is when. That's the question. When I would do it. And I was thinking maybe we're gonna have ex-dividend date coming up this week on Ulti, so I'll look into that. Now I'm going to talk about some nuggets that I learned from the interview with Jay. I mean, there were a lot of things he discussed, but one of the nuggets I took home was a lot of times I was thinking to myself, like, from what point, when you have declaration day on the Yieldmax funds, which comes out on Wednesday, payment is ex-dividend date Thursday, payment is Friday. So he said basically Monday is when they calculate what the amount would be in the declaration date. So they calculate what it's going to be on Monday, and then basically whatever happens in the market in your underlier, from Monday-ish, whenever they do that calculation, Tuesday, Wednesday, Thursday, Tuesday and Wednesday is probably not factored in, if you know what I mean. I mean, obviously Tuesday's not factored, Wednesday's not factored in because it's already declaration day. But I'm saying whatever happens like Monday-ish, Tuesday, I would imagine is not factored in if they already calculate what happens on Monday. So if you see some kind of earnings or some kind of move in the market and you don't see it included in your fund, it's probably because it happened on Tuesday, or you know what I mean. So it may be seen in the following month. That's what he mentioned in the video. You could watch. I'll put a link to Kamir's video, the interview with Jay. And then he talked about like credit spreads. So of course, every single type of option strategy fund that you use, again, I always emphasize it's very important, even for the novice investor that doesn't have too much experience in options. I would definitely, want to send the message home to learn about options, learn about what you. I mean, I'm sure you all agree. You need to know what you're investing in. You need to know what your risk is. Knowing your risk is paramount before you get into the water, knowing if there's any sharks in the water and how to mitigate those risks if you can. If you don't know the risks, you're setting yourself up for failure if you don't understand the risk. You have to understand the risks getting into it. I would definitely want to advocate that you should definitely educate yourself. You don't have to know every single aspect of margin, but if you're going to a cover call strategy, option play, then learn about cover call strategies. If you're doing credit spread strategy, learn about credit spreads. At least know what the pros, cons, which market environments they would be more favorable for those positions, which one not, strengths and weaknesses. So again, these, like for example, the cover call strategies that Yieldmax does, there's some weaknesses. That's nothing to do with Yieldmax. It just has to do with the strategy. So Jay mentioned that, obviously with the call, with the cover call strategy, sometimes, when the market goes up, call credit spread is good in down market or neutral market because it would outperform the market. But when the market goes up and it keeps passing through the strike, of course, you have to manage the position. It would probably not all the time, probably underperform because that's the way the strategy is set up. So the worst case scenario is when you have a quick down and then a quick up. When the market goes all the way down, it brings the underlying down with the entire market. And then when it goes up, but if you're capping your upside because you're selling a short call, you're going to be limited unless, of course, they can always roll it, move it, close it. There's a lot of things they can do to manage it. But you have to understand, that is a weakness. But what Jay said, and it's very unique to Yieldmax, I haven't seen other funds that do this, is they have in their prospectus, and they do it, they can do call credit spreads where they can capture some of the upside so they don't get whipsawed with these quick down, quick up, and they don't get tapped out. They have these other tools that they can use at their disposal. And I've talked about this, and you've seen, I'm sure people who have studied the Yieldmax funds know about this very well. And this is something really, really unique that they can bring in extra income where it would not have been possible. So that's really, really cool. He just re-emphasized that. We spoke about the new type of, there's new funds, obviously, they always have new funds coming out in general. They have new he said possibly new strategies, probably possibly theme-based, but we're going to find out what's going on. I asked him again. I got to ask a few questions on the interview. I'll send you the link. What about strangle funds? Because the reason why I talk about strangle funds is basically, and you can look this up a little further, is that you may get double the amount of dividends in these funds potentially, because a strangle is a short call, short put. So you're selling theta on both sides of the trade, and you could potentially get double dividend funds. Whatever dividends you're getting now, can you imagine getting double the dividends? That's why I asked him about it. And those type of strategies usually are not typically, the way the option is set up. It's good for a neutral market. It's not very good in a directional market, whether it's directional up or directional down. It's very good in a very flat market. So he did say that, it's very challenging to do, and they're not, and from what I understood, what he said is that it's hard to do this type of funds in an ETF because there could be lots of problems with NAV erosion. There could be problems. It's very, very hard to manage. And again, it's very directional. And I asked him also, why is the cover call strategy ETF fund so popular? Which I mean, I have no problems with it. It's an amazing strategy, but why not do a short put strategy? I mean, of course, there's the defiance in the money put, but I'm talking about like an out of the money put type of strategy. So he did mention there are a couple out there. There are a couple out there, but basically, um, they're not with the cover call strategy. You are able to capture some of the upside. So there is a way to get some capital appreciation. So he mentioned that in the put strategy, it tends to be very and usually not very volatile, but sometimes it could go down, but it doesn't really, it doesn't have that upward momentum, which a lot of the consumers like. He did mention there's a fund called THTA, which it looks like it does put credit spreads on treasury products. But he mentioned, like, of course, they have a distribution rate of 12%. And you could see here, what they do. It's opportunistic high yield. Some people like to compare this to SFAL, but it's a little different. It's by SoFi. They can see the 49.49 expense ratio, and you can see the different distributions, 17-ish cents. But again, it's 12%. It's not that great. You see here the treasury products, and you see here they have the puts, the SPX US puts. So yeah. And here you could see the chart on THTA by SoFi. So you could see here they're pretty much flat-ish, but sometimes they drop and they haven't really shown that they could come back to the original price. They start off around 20-ish, and it's just been flat, 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 and all of a sudden, bam, August 8th. Remember that August 5th, everything dropped, and then it's back to stable, but it never really came back to that original level. Now it's hanging around the 18, close to $19 range. So he mentioned that it lacks that upside potential like calls do. So that's why he mentioned that a lot of people don't are not. It's not that attractive to the typical investor, but some people like it because it relatively has that stability and a good consistent payout. So he says it does appeal to some people. Well, that's the end of this exhausting video. I hope you guys enjoy. Have a wonderful weekend, and best of luck.